What is up, everyone? Today is an interesting day. Today is where we're going to determine the fate for the next few months of what is going to be happening with Bitcoin and cryptocurrency. So, as you can see, my screen is littered with madness going on right now. So, I only have this one up because I need to watch for live chat. So, I'm going to set this over here on the side so I can watch for comments. And I am going to be watching the countdown. I also have a video up which is also doing the countdown and keeping live coverage to what's going on. I have the live Bitcoin chart over on the right, which is watching price action. On the left, I'm watching altcoins. I can change that if desired by anybody. Like if you want to watch Bitcoin rather than Ethereum altcoins to see who's best performing, just leave a comment. Up here is the Fear and Greed Index. They update every 6 hours, or 6 hours from now, I should say. Obviously, it's pretty bad right now. So we'll get back into that later. And I will just keep in touch with everybody to let you know what's going on. During the live chat, I will be updating people on good news and bad. Remember, Bitcoin was created as a hedge against the stock market, but because traders and scalpers and people that love the trading got into Bitcoin, unfortunately now, hey, Redefine Living, what's up, man? Unfortunately, so many traders that are in the stock market have moved into Bitcoin that now they're almost tethered together. When the stock market doesn't do good, neither does Bitcoin. We would expect that a lot of traders would jump into Bitcoin because it's unregulated. The things that are illegal in the stock market, they can get away with in the crypto market. And they've taken their experience over the time and they've manipulated a lot of things in cryptocurrency. So because America is so invested now in cryptocurrency, we are going to see what this bill is going to, in effect, do to us in the short term and the long term. So if gold and silver are something that people move into, or are they going to print more money? Are they going to raise the debt limit? All of these things are going to determine how Bitcoin is going to perform. So have they been keeping the price high intentionally, or has this not been a coup all along? Are we actually going to keep raising and going up in price? Because as you can see in the bottom right-hand corner, by just looking at the price action, Bitcoin's holding pretty well for how high the fear index is that you can see over here. Usually when the fear is this high, it's a crash. The last time the fear index was this low, Bitcoin, it was in March and Bitcoin crumbled. But yet here's Bitcoin holding, even though the fear index is that high. So it really must be coming down to this CME update that we have now in 46 minutes. So I'll shut up now and you guys can listen to the analysts on their predictions on what's going to be happening today. And if you want me to cover anything in particular, just let me know and I'll come back. Actually, I'm just going to be sitting here watching as well. So
multiple times in a year, because they recognized they needed to move quickly to make sure that inflation didn't surge back upward. And the situation we're facing now, that they might have to even move more aggressively than they did in 93, 94. This complete change, the pivot is not done. Chair Powell has to make more of a pivot today and more again in January and more in March to help markets get used to the extent to which we're in a very different situation than the Fed was expecting a few months ago. Very different.
Yeah, and you're talking about 93, 94. Hopefully we don't have a repeat of the Volcker era in the early 1980s. Really appreciate your time here. Andrew Levin, former Federal Reserve Board Special Advisor and Dartmouth College Economics Professor. Step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek, ad-light experience. Check it out today at yahoofinance.com/plus. And coming up after the break, we got an update on everything on the COVID front.
Oh, no. All right. Well, there's no one talking right now, so I'll come back. All right, everyone. In the bottom right-hand corner of the screen, you can see what Bitcoin has been doing. It's been hovering around the 47,000 mark for quite a while. Every so often, it'll go a little bit higher, and then it'll dip back down. We would expect to see this because as it's getting closer to this countdown to where we're really figuring out, these are scalpers that are now taking their actions and they're making the profit right now. That's for short term, and they're really good at it. So let them make profits off of the people that still think we're going to go to the moon tomorrow, even though there's no price action at those levels. That's still beyond me. So we're going to be keeping our eyes on the realistic things. And what's realistic is there's a lot of resistance being made at the $40,000, meaning that if it dips down, there's a lot of orders that people have set at around $40,000. For example, there's a couple 600 Bitcoin orders. Well, that's a lot. So that's what I mean. They have to break through that resistance to get lower than 40,000. Is it a possibility? Absolutely. We could go down to $38,000 even today. But could we go higher? Yeah. But there aren't a lot of buy orders over $50,000. So why would there be? Why would we shoot up to $60,000? It makes no sense that we'd go to $100,000 when there's no buy orders for that happening. Now, could it? Sure, everything's based on the perception of what the market is going to do. But so many people recently have gotten out of crypto because of this, of the fear of the market, on the potential of what's going to happen today, that more people are cautious and don't think that it's going to play out good, that they're leaving. We have in the cryptocurrency popular world, we have Chico Crypto, who essentially kind of is cashing out, right? He's gone. He's extremely popular. He watches the market very closely. And we also have Supo Man. He's the guy that watches a lot of altcoins that are coming up and trying to figure out which ones are essentially rug pulls. They're fake. They might have huge potential, and he's out as well. Anyway, we're back on live.
Variant across the country could lead to a surge in cases come January. That is, the variant has now been confirmed in at least 35 states. Here to discuss is Dr. Julie Morita, Robert Executive Vice President and former Biden transition COVID advisor.
Today is the day when we determine what's in the paperwork for the new bill that's going to be in front of legislation. Is it going to raise the debt limit, or is it going to print more money, or are they going to distribute funds differently? Are they going to raise taxes? We're going to find that out today. So today is a huge economical day, because the bill is going to be passed, and we don't know really what's in it yet. And frankly, neither do they, which is a typical politician move, right? We need to sign it and then learn what's in it later. So they're just going to be reading the footnotes today, and we're going to probably know around 2 o'clock everything. So in 4 hours, we'll know everything we need to know. Unfortunately, during that process, there might be really bad news, there might be good news. So I thought I would stream as much as I could. I don't know if I can go 4 hours of this nonsense. Here they're talking about the COVID variant and how it's spreading. We know, guys. Okay. I was hoping this would be more focused on the financial aspects of things, but it might not be entirely that. As you know, bills that pass cover a lot of different topics, but this one specifically should be directly geared towards watching the finance. So what do you think most of the speculation and outcome all of this has been somewhat priced into the market already? Well, so far we've had a lot of people going into the market, even though they're worried about this new bill. That's a good sign. But there's also been a lot of lies. For example, if you follow a heat map, you can see that what's illegal in the stock market is not illegal in cryptocurrency. So what we've seen is that they have a lot of buy orders over $50,000, but they're not real. Because when price action starts bringing the crypto over up to $50,000, they remove their order. So why would they do that? Because they want people to think that there's still a lot of money in Bitcoin to be made right now and that the price is really high when it's not. So when I see manipulation inside the market like that, it makes me really cautious and makes me think that it's probably going to go down. Now, we won't know today because 24% of the investors are in cryptocurrency. So when you have that many people in the stock market in cryptocurrency, you're going to expect them to be manipulating the market the most because they're specialists at it. Most of us aren't. We invest a little bit of money in something that we hope is going to go up, and they manipulate markets to work for them. And they mostly do it with Bitcoin. Look at the volume. Ethereum doesn't do the volume that Bitcoin does. So it's harder to manipulate, and therefore it's a safer coin in my mind. It'll perform better than Bitcoin because everybody knows what Bitcoin is. Matter of fact, if you talk to somebody and you say, do you like Bitcoin? They'll go, oh yeah, it's great. In reality, they think Bitcoin is a cryptocurrency. They don't know the difference between the two. But these traders, they're masters of it, and they know really what's going on. So I'm hedging my bets that it's manipulation right now. But let me check the next question. So then this process might take much longer than today, as we see in the future more effects. Yes, we'll know over the next 3 months but this will determine if we're going to drop into the bear market for the next 3 months. So yeah, it's a crazy time, and a lot of coins are going to die. For example, a lot of altcoins that don't have any intrinsic value and they're newer, let's say they're legitimate coins as well. Let's say that I invent a coin and it's legitimate. I've done everything I could possibly do. I got sponsors. I've got people to check the coin to see if it's fraudulent, and it passes, and it releases today. Well, today's a shitty day to release a coin. And the reason why is because everything's based off of the population on how they view it. How do you view the market is doing? It's all perception based. If perception says, oh, it's not going to be good in the future, well, we're not going to have a lot of buys. So therefore, if there's not a lot of volume, new tokens die. And that's unfortunate because there needs to be volume in everything. So that's the unfortunate news. So if there's a new token out, it would have to have utility, and those utilities have to be where people want to put their money, even in a bad market. And when people are scared, they don't put their money in anything except for what's more stable. So if today more people are dumping their money into gold, then theoretically crypto should do good because it was created as a hedge against the stock market, like gold. Unfortunately, so many people now invest in the stock market and in crypto together that they are almost tethered. So when the stock market does good, crypto does good. When it does bad, it does bad. So unfortunately, it's no longer a hedge against the stock market. They do a lot of similar price action. So we have to be careful, and we have to watch the stock market now because there's a lot of similarity between the two. Bitcoin does good, stock market's doing good. Stock market does bad, Bitcoin does bad. So unfortunately, that's the way things play out. And it shouldn't be that way. Theoretically, today, they could say, we're going to print billions, no, trillions of dollars, and it shouldn't affect Bitcoin at all. But unfortunately, it does, and it's going to. So we have to know what the outcome of this is, what their plan is, and how much it's going to hurt us. And I would assume a 3-month stepping in heavy mud where we just have to trek through it, which would be considered a bear market. Now, most bear markets, when Bitcoin isn't performing, it's called an alt season because altcoins will do pretty good, meaning like a Gala token. It's a gaming token, right? Why would that do good? Well, look at them. Right now, they're talking about the new COVID variant. So therefore, people are more inside. The variant drives people from their daily life indoors. It tells them to protect themselves. So things like Netflix on the stock market do really good, and gaming on cryptocurrency does it good because they're play to earn games. You can sit at home and still make some money. Will it be good? Well, I don't know. Anything is better than nothing, right? So these play to earn games do really, really good. And that's why when markets are usually doing bad, even Bitcoin, gaming things do very good. So they're trendy right now, very similar to NFTs, but an NFT doesn't do anything for you. They just might go up in value by holding it for a while. But again, that takes time. Gaming is something that you can do with your time to have fun, to pass the time, which is exactly what kids who are bored and have a lot of energy and want to be outside doing something and they can't. That's the hedge that I'm betting on most people are going to be doing during COVID. And so let's hear what they're talking about now. We got 34 minutes left till they're live.
I understand he's not exactly on board with the Biden administration.
Hi, Jared. That's right. After the Senate Banking Committee held a hearing yesterday on stable coins to better understand how they work, to fashion new rules to regulate them, I spoke with the chairman of the Senate Banking Committee, Sherrod Brown, to understand how he's thinking about formulating rules. While he doesn't seem to be quite on board with stable coins and worries about possible financial crisis without the proper rules in place, he does seem to be minded about regulations that could be levied. Says he doesn't want to kill innovation. And to your question, and asked whether he supports the Biden administration's proposals that only banks should be allowed to issue stablecoins, the senator appeared open-minded. In this second installment of my interview with Senator Brown, we talked about what could possibly propose legislation next year and how possible rules could impact Facebook's stablecoin. Take a listen.
I guess I would answer it more precisely, Ms. Schoenberger, this way. There are 3 federal agencies that are looking seriously at this. I'm hopeful next year the Senate Banking, Housing, Urban Affairs Committee, working with the House and Senate colleagues, can put some rules on the table about how to do this.
Senator, are you prepared to put forth and propose legislation to regulate stablecoins or crypto in the new year?
Yeah, I am. The answer to that is I don't know yet.
Hey, Chris.
I am certainly looking seriously. My staff on the Banking Housing Committee is looking seriously at that. We're consulting with the regulators. I know that SEC and the Fed, especially SEC and also the Fed and Treasury, are in this space already looking to write rules and regulations around this. They may recommend that Congress take action too. I think from some private conversations they might. I'm ready and willing to do that. I'm not yet able to do that in the sense of knowing specifically how to do that and which direction. I mean, I know the general direction, but I don't know the specifics yet.
Follow up there. Facebook parent Meta Platforms is looking to pursue a stable coin, assuming they continue down this path. Would they be regulated as a bank, or would they perhaps be shut out, given that in the past, Congress hasn't really allowed non-banks to play in the financial services box, right, and offer banking services a la Walmart in the 1990s?
Right. That's a very good question. There's a murkiness there that makes me unsure, except that I know the power of the tech companies, and I know the tech companies seem to want to be in everything. And I know that the financial services, a significantly larger. I grew up in Mansfield, Ohio, and I remember walking the halls at, you won't believe this was the name of my junior high, but at Johnny Appleseed Junior High and Mansfield Senior High, with the sons and daughters of a whole lot of union members, union workers, steel workers, machinists, rubber workers, auto workers. And most of those jobs are gone. And those jobs in part are gone because of the financialization of our economy. A much smaller percent of our GDP is manufacturing. A much larger percent of our GDP is Wall Street and all that surrounds Wall Street and feeds into Wall Street. I'm concerned about tech companies' power. I'm concerned about their reach. I would be I'd be reluctant to give them the authority to get into this business. We've got to figure that out, how we write this in a way, both the regulators at SEC and we on the Senate Banking Housing Committee, to write this. Again, I come back to this, sorry, the broken record, to protect the public.
Inflation just hit a nearly 40-year high. Those who are least able to afford these higher prices are bearing the brunt. The child tax credit is set to expire at the end of this year. There is a clause within the Build Back Better bill to extend that for a year. If that is unable to pass the Senate by year end, are you prepared to offer some sort of short-term patch, or could there be a retroactive clause in the Build Back Better plan to expand this child care tax credit?
Well, we're going to keep the child tax credit in Build Back Better. It's going to pass, whether it passes in December or January. The child tax credit, I've started working on this bill in 2013. 92% of families in my state who have children under 18, 92% of families are getting at least a $3,000 tax cut from this bill, from this law. It makes a huge difference in their lives. It's going to continue. We're going to make sure of that. And it's something that I will continue to fight for. It will be part of Build Back Better. It will be signed into law by the president. We're going to continue it.
And of course, the last installment of the payment for the child care tax credit going out today, unless extended. Back to you.
Okay, and Jen, you say, he's not opposed to stable coins coming into the banking system, but it does need to be backed. How does he propose that happens?
Yeah, so Senator told me at a minimum, the stablecoin crypto need to be brought within the perimeter of the banking system. And he thinks levying current bank goals would be in line with that. He says at minimum, there should be a one-to-one backing of US dollars or short-term treasuries, and that those reserves need to be audited by a third party, and that companies need to be transparent about them.
And we thank you for that report. Yahoo Finance's Jennifer Schonberger. And coming up after the break, ever fantasized about walking out on the job? Maybe a little rage.
Oh, geez. Okay. These companies don't have to essentially invest into Bitcoin to make money. They manipulate the market like they do. They essentially can create their own token. So there's nothing stopping anyone from creating their own coin and putting it on the market and manipulating it from there. And a lot of people do that. There's two versions of that come to mind. There's one is a rug pull, and the other is a slow rug pull. Now, what you watch for when you're looking for something like that is you go and you look at a thing called tokenomics. It's usually in their white paper. And I can give you an example of this. We can go and we can look and see how many wallets there are and who owns them and why they own them. And then you can look at how many wallets are attached to those accounts. Like you can literally look and see if that person has another wallet, and then if they have more wallets. And a slow rug pull is somebody that started the token that has a wallet that with a lot of tokens in it, and they slowly take them out of the market and put them in these other hidden wallets that nobody knows is theirs. And it looks like there's people purchasing the coin when it's them stealing money from the entire pool of them, slowly rug pulling the token away from investors. So investors thinking that people are buying the token because they see the value going up and tokens coming off the market. In reality, it's the person that created the coin slowly rug pulling it away by stealing tokens from that market into their own wallet. That's the more hidden version of it. And that's much harder to see. And that's harder to look for. Obviously, it takes a lot more time. But there's people on YouTube that specifically look for that. So if you ever question if a coin is legitimate, just type the name of the coin in and then type scam and see if anything pops up. And that would be the first clue. Now, of course, YouTube is much harder for a lot of people to write about a scam token because you would have to make a video, and not a lot of people are going to do that. So the next best thing would be just type it into Google, and you can find it in forums. People will be spamming, hey, this is a spam token, I lost my money, nothing ever showed up. That would be the secondary case. Now, a big rug pull is when people just flat out steal everything all at one time. You can't anticipate that, unfortunately. That takes one fraud out of like 10 people to even do it. And they'll steal millions of dollars and they're just gone. So that's why it's so important that if the token is listed and it's owned by somebody, to find out if they are doxed. And if it says that there is an owner and they plan on doing different things and you don't know who they are, then probably don't trust it. That's one of the red flags to look for in a token. So there's many things that can happen, but these big companies that have already millions of dollars, they're probably going to create their own token, or they're going to get involved and become partners with people that already have one. And that makes the most sense, because why start over from scratch, but also why hedge your bet and put your money in something like Bitcoin when you're already wealthy and can create your own. See, it's different for banks. Banks aren't going to create their own because they say that they're against cryptocurrencies. So they hide their money and they put them in crypto. And that's how they hedge their bets, because the dollar is going down in value. There's no doubt about that. But cryptocurrencies are going up in value over time. Obviously, there's dips and there's things where it goes down, but it never loses its value like the dollar does. So banks, they hide their money. That makes sense for them to do, but not big corporations. Anyway, back to it. Let's see what's going on now.
Viral video that's got 8 million views. And it's addicting to get that kind of feedback from your audience. I mean, people are loving these rage quitters. We're loving supporting them. We're loving seeing people stand up for themselves. It's that David and Goliath, that storyline that continues to resonate with people. I really encourage folks to be empathetic to people who are quitting. Clearly, they have been through some stuff. If they are going to go to these great lengths to assert themselves to their employer and say, you know what, I'm not going to stand for this and I quit. So I honestly would turn this from looking negatively upon the employees who are going out of their way to embarrass their employers, and take a couple of steps back and ask ourselves, what's going on with workers? Why aren't they feeling respected? And how can we better train managers to handle employees?
All right, Mandy. So let's say I'm going through this in my head. I'm kind of thinking about it. I'm gaining the courage to rage quit, or maybe just quit. But without making a spectacle of it, what should people be doing to prepare themselves before they quit, or at least quit publicly?
Absolutely. I would say if you're getting to the point where you are enraged and you're at that breaking point where it's going to bubble over and you may snap, take a step back and try to focus on yourself first. So I really encourage workers, don't let it get that bad. Don't become so disgruntled, so unhappy. There are actually steps that you can take to prevent that type of rage from bubbling over. The first and most important point I'll make is setting those boundaries at work in the first place. It has never been easier for people to Slack you, to Zoom you. We're in touch with our employers, our colleagues all the time. And I think it's even more crucial these days for people to draw a very firm line in the sand between where they're willing to sacrifice their personal well-being for their work. And it may sound uncomfortable, but I don't think enough workers are doing this. They're not setting clear boundaries. I will not be responding to emails after 6 p.m. Eastern Standard Time. Thank you very much. Those are going to go, directly in my top of inbox for the morning. Setting those clear boundaries is how you're going to let people know where your limits are, and let them know that you demand respect for your schedule and your time as well. If that sounds terrifying to you, and it may sound terrifying to a lot of workers out there, or they may find that they've tried to set those boundaries and they have been dismissed, they have not been taken seriously. I think if you have put your best foot forward, you've tried to set your boundaries, you've tried to give feedback to your manager on how you like to be managed, and the response is, oh, we don't care about that, or, well, that's not good for business, then I think it's time for you to be coming up with your plan B. Where are you going to go next? Forget trying to rub it in their faces that they've lost you. What's your next career move, and where are you going to go? And luckily, you're in quite a good position given the fact that employers have never been hiring the way they've been hiring lately, right?
Yeah, absolutely. You know what? All good advice there. And hopefully employees don't get to the point where they feel they need to do this, because if it's on social media, it's there forever, right? And it may come back to bite you. So be careful is, I guess, the best advice before you sort of think about doing something like this. Thank you so much, Mandy Woodruff Santos, Yahoo Finance contributor and co-host of Brown Ambition podcast. We will take a quick break. And despite a tech hangover the last couple of sessions, many analysts are still bullish on Apple. Why so much love for the tech titan? Find out after a quick break.
Wow. So we learned nothing about anything for that one. Basically, they were talking about how social media you can hurt yourself doing it. I mean, come on, people. We know this. You don't. How insane that people are still streaming everything they do in their life to the point where it destroys their future for getting jobs in their life. Bravo, people. Come on. You're going to rob a bank and then post yourself holding the money? I mean, are we still at that level? I mean, do people not learn from other people's mistakes? This is so crazy. Anyway, look at Bitcoin. Look, it's doing good. Hovering around 47,000 still, jumping between those numbers. Nothing really new for today. The chart should be zoomed out a little bit. Probably wouldn't look so drastic like it's moving up and down. That event starts in 19 minutes. So as you would imagine, it's probably going to be slow and tedious. So I hope that they just jump right in, but there's probably going to be a little slower starter in the beginning. Ooh, look, NASDAQ was down. I wish I could rewind a little better. Missed it. Crude oil down. Well, that's good. That should mean gas is cheaper. I doubt we'll see that, but you never know. Look at this. Yeah, people from around the world are watching. Amazing, right? They're watching to see what America's going to do. That's fascinating that America influences that much still. Pretty amazing. The US dollar is, it matters a lot, especially with China. We deal a lot with them and they deal a lot with us. So they don't want us to cripple ourselves. But unfortunately, we can't help doing it to ourselves. It seems like we just keep printing more and more. They hope that the next president will eventually come up with a solution and deal with it. And I don't know why one of them just doesn't say, we need to cut spending to the military for 1 year. We would literally be up billions and billions of dollars. Like, come on, give up building planes and helicopters. They can literally be shot down with new technology within seconds. So putting billions of dollars per helicopter and per plane is a waste of money. You don't need that many anyway. The military is definitely taking up massive amounts of funds. If there was a hold put on military funding for 1 year, national debt would probably be half solved. And I mean, this isn't even my field, and I can think of multiple areas to fix the economy. I can't believe that these people that are literally paid to solve the problem come up with no solutions at all. They say the same regurgitated arguments that everyone else does. Oh, we just raise the debt limit, print more dollars, tax more. Yeah, we've done that. Has it solved anything? No, it delays it. This is ridiculous. So we need to work with our money the best that we can, and we want the dollar to be good and strong, because when we cash out of crypto, guess what it's going to be in? Probably the US dollar. Now, that's not true for everybody, but because the US dollar is influenced by the markets around the world, the incentive for us to maintain the dollar at some value is very important. So, very strange to me that there are no good solutions that I'm seeing anywhere. It's kind of like when a bunch of oil gets dropped into the ocean. They're like, what are we going to do? We got to fix this. There's nothing, we got to filter it out. It's like, okay, well, let's see. A farmer came up with a solution a long time ago that hay absorbs oil like crazy, especially in the ocean, because the oil will float to the surface and so will the hay, and the hay absorbs it. Then you just walk around and you scoop it up and you pull it out, rather than it dispersing with the tides and the current and never being able to collect it. This solution resolved the problem on a small scale when I read through a study that a guy did and said, look how easy it is to fix an oil spill in the lake. So he flooded his local lake with oil and absorbed all of it with the hay that he had from his own farm. Now imagine that. Easy solution, right? No one ever hears of these things. It's insane. Like the first electric car. Remember in the 80s when they invented an electric car better than all of the electric cars that exist today? And they made a movie on it called What Happened to the Electric Car? The owner mysteriously died. The car and the schematics are disappeared. You can't do anything because it was apparently a patent that the guy had, so nobody can copy what he did. And then he gave it away for free online and said, "I'm worried for my life, so I want everyone to know how this works." Yeah, well, that's gone. Everyone forgot about that. And then, of course, Tesla and them come out. Well, guess what? Those have lithium. They have heavy metals in them. They have things that pollute the environment in them. So electric cars are worse for the environment than gas and oil. Ironic, isn't it? So it's very bizarre to me how we undermine ourselves. We hurt ourselves down the line. Look at Bitcoin going crazy. This fearful market, and here it's shooting up again. 13 minutes until we figure out what's going to happen, and you're going to dump your money in something like this is crazy. It doesn't even make sense. I don't trust it. And what I was talking about earlier, when there's manipulation in the market, that is called a short squeeze, and it's illegal in the stock market. You can't do it. You can't just say, "Oh, I'm going to dump a ton of money in at a higher price point to make it look like it's worth more value and then pull your money out." It's completely illegal. A short squeeze has been known for a long time, and they do it all the time in crypto. So I like finding the altcoins a little bit more because when they're early and they're new and they have an intrinsic value because they offer utility and they're not some type of a meme, then you know that there's going to be money coming in, and the manipulators aren't there yet. There's no reason. You can't manipulate something that's not worth anything. So the only potential way for it to go is up. That's great. What is the name of that 1980s electric car? It was a movie that came out. I don't know the name of the car. I don't know if it actually had a name. It might have. I'll look that up, actually. That's a good question. I just know they just called it the electric car because there was no competition. There was nothing like it. There was nothing even on the horizon. There was just one guy making them.
Apple, and what are the analysts cheering about right?
But it already has some kind of set up capability where, AR, VR, we're still trying to figure that out. So it'll be interesting to see what Apple's kind of thought is and what direction they want to take it.
Yeah, if anybody can figure out AR and VR, I would bet on Tim Cook. Why not? Yahoo Finance's Dan Howleys, thanks for stopping by here. Well, coming up, as you can see on your screen, we got 12 minutes to that big FOMC decision. We're going to handicap it and break it all down for you after this.
Well, I timed that one wrong, huh? I missed that entire segment talking. My bad. I looked it up. It says, before Tesla, 1980s electric car, EVs, part 2. They said many electric cars debuted in the 1970s, but not many sold. Limitations in range and speed were a problem, and the popularity declined in the 1980s. Yeah, the 80s is where they made the first really good one. And this thing could go for miles and miles and miles and go fast too. They didn't like it at all. The first electric car on the market was called Electrobat. It was developed by a mechanical engineer, Henry Morris, a chemist of all things, in 1894 Philadelphia. No, that is not what I'm talking about, but that is insane. That's all, or 100 years ago they had an electric car. Incredible. What in the world? Do a YouTube video on that. Oh, electropad. Let me scroll up. Electrobat. I'll type it in. But we're talking, this is over 100 years ago. This isn't the car I was talking about. Let's check something real quick.
Welcome back to Yahoo Finance. Well, we are just about 10 minutes away from what could be the most crucial Fed policy meeting of the year. Here with his take on what we can expect and how markets are reacting is Alfred Eskander, Salt Financial President and Chief Operating Officer.
There you go. Who Killed the Electric Car? Documentary, 2006.
Sense of what you make of the markets ahead of the decision today and the retreat that we've seen over the last couple of sessions in equity. Is there some repositioning that's been going on?
We believe there certainly has been, and we had picked up some elevated vol going into this week, as we've seen for the last couple of days, with two sessions of down days as the vol has been elevated. This is a very important meeting, as we all know. There's only 12 trading days left in the year, and if you think about it, it's probably the only real catalyst for any major move one way or the other before the year's over.
And Andrew, just thinking about market participants looking for an end of the year rally, so-called Santa Claus rally, typically happens, but it doesn't always. You think back to 2018 when the Fed was front and center yet again, and they probably committed a policy error by raising rates too many times, and the market sold off precipitously after that. I'm just wondering, what are the odds that we have a repeat of that same situation where markets don't like the hawkish tone of the Fed?
It's a great point, and we could easily have a repeat of 2018. If you recall, after I believe it was the December 19th meeting, the market traded down 5 days in a row, giving up almost 8.5% of returns. So that is likely. What we've seen so far is the Fed has changed its tone. It certainly has become more hawkish lately. But also, you got to take into effect the fact that we've had a tremendous year. We've had great returns, and there's an incentive almost for the Fed to just kind of rip the Band-Aid off, because even if you have a similar repeat of 2018, you're still going to finish the year in double-digit returns, which helps really reset portfolios for 2022.
What sort of volatility do we see in the first half of next year, given that there is going to be this tightening that goes on, and what assets are most vulnerable to it?
Yeah, so Karina, that's a great question. And what we do is, when talking to advisors, is really get into the portfolio overall and try to understand how sensitive is it to shocks like this, or potentially, even greater volatility going into the new year. And if you think about it, there are more things than just stocks and bonds. I mean, there's other innovations that have happened in the market in the last 10 years that really help long-term investors cushion that volatility, protect income. And I'm talking about products ranging from fixed index annuities to structured products to even some of the most easily attainable, which are buffer ETFs. So I think it would be a service to investors to talk about and learn about these products, because they do offer a certain diversification that simply bonds don't offer right now. And if you're thinking about protecting income, I don't think anyone's telling you to run in with both feet into fixed income.
And I got to ask you about your outlook for inflation as it affects all asset classes and risk markets. What do you see happening? I think the transitory thing is out the window. Even Powell says we're not talking about that or using that terminology anymore. But at what point does inflation peak, do you think, in the coming year?
Well, inflation is real. I mean, I experienced it last night having dinner in the city at a very well-known restaurant where the prices seemed a little bit bigger, and had a little technical issue with the credit card. But otherwise, it's just more expensive, and there's no way to avoid it. We just saw the CPI with a 6.8 handle, and that's real. People do feel that, whether you're out to dinner or you're in the supermarket. There's no way to avoid it. I don't think it goes away anytime soon, especially with the spending bills that we have. But again, I go back to volatility and understanding how you're positioned for 2022. We've got elections coming up. We've got Fed decisions. There's a lot of things going into where investors really need to focus on volatility, how to protect income, and how to diversify, not just with stocks, single stocks and bonds, but with other more innovative products that will actually behave the way.
Are you telling me that Yahoo Finance can't figure out how to put people on slow-mo? They let people spam their live chat? That's so dumb.
Advisors to teach their investors about these things.
Look at that. Just spamming,
because,
I'm shill. I'm a shill over and over.
An unbelievable array of products, when put together correctly, will really give an investor, certainly for the long term, a much easier way to sleep at night.
All right, we will have to leave it there. Alfred Iskander, Salt Financial President and Chief Operating Officer. We're all on the edge of our seats waiting to hear what the Fed decision is. Just ahead, our Fed special, we bring you the central bank's decision on likely accelerating tapering and what the dot plot looks like, as well as taking you live at the bottom of the hour to comments from Fed Chair Jay Powell. Stay with us.
Well, that's the first thing I've actually heard anybody say. She said accelerated papering. So basically, we're going to be printing more money by the sounds of it. Okay. That could mean more money to go into Bitcoin, but it could also mean our dollar dips in value a little bit. So a positive and a negative. But at least we got some information. At least somebody said a prediction. So far, I haven't heard anything about anything. So that's crazy about the government trying to shut down Telegram. Yeah, that is dirty. That's psycho. That's just dictatorship. Control. Don't, like China, right? Don't let people have social media. Don't let them see what's going on outside of the free world, like in North Korea, right? No ability for the people to know what's going on anywhere else but there. That's psycho material. Man, it's too bad too, because Telegram is actually the best way to keep up to date with a lot of things that are going on in cryptocurrency, especially with your in particular token. For example, if I find a token and I've read everything about it and I go, I trust it, let's see their Telegram, because Telegram is kind of like Discord, but more people have it, and you can see the community. You can see like how into it the people are. You can see how they a group of people that shill the token, meaning just a bunch of people trying to like boost it up themselves. Is it a fun token? Are people having a good time? Are they always keeping positivity? Or is it just like a dead chat room? Those things are important to know, because you're putting your money there. You have to know where your money's going. It's like, if it was a stock market and you walk down the street and you go into a store and you're like, I like smoothies from here, I wonder if they're on the stock market. Are they public? And you go, oh, they are. That's really good. I think they're going to take off. There'll be a huge chain one day. Well, you put your money there. You know it. You walk in there every day. You deal with the clientele. It's kind of like when you walk into a Trader Joe's. You ever notice how friendly everybody is that works there? You're like, oh, this is going to do really good one day. They're on it. They have like 800 cash registers. So there's no big lines that form. Their products are fairly cheap, but they don't have any preservatives in their ingredients. So they have like a niche that they filled that made them different than everybody else. Well, what makes tokens on cryptocurrency different? Well, it takes so much investigation, because you can't walk in and go look. You have to investigate online, and anybody can lie. So it's really hard to determine what is going to be the next big thing, because everyone knows getting in early is what matters.
Big FOMC decision in less than a minute.
And here we go, guys. About less than a minute away.
Adam Shapiro standing by.
I will start shutting up now. But if I see any questions, if I can't type it, I'll probably just turn down the music and
and
say something if I hear something in particular as well.
Ever so briefly, S&P 500. That's
I'll
down
turn it up.
about
Let me know if
13
there's
basis
any
points.
volume
Nasdaq
issues.
down 0.5%, but
I
well
might
off the lows. And with about 29
turn down the
seconds here, I wanna
watch
go to the Wi-Fi
ping
Interactive
sounds over
just
here.
A quick check of the bond market as well, because we've seen yields under not pressure, but we've seen them volatile recently. And if you take a look at what the 5-year T-note yield is doing, it's up 1.25%, up 1 basis point. We got the 10-year here. That is up about 1 basis point as well. And the 30-year up a little bit more. We'll be keeping a close eye on this, as the Fed decision usually moves the bond market more than equities.
Look at those cells.
And it is 2 p.m. and that means, guess what? We're going to bring in Finance's Brian Chung, who has all the latest. Brian, can you break this down for us?
Jeez. Well, breaking news, the Federal Reserve has officially doubled the pace of its tapering program. Again, the Fed was buying trillions of dollars in U.S. Treasuries and agency mortgage-backed securities since the depths of the pandemic to message to markets its commitment to keeping its easy money policies. Now, the Fed set a course in November to start to pare back those purchases to bring it to a full stop by the middle of November. That pace set forth in the first week of November was about $15 billion per month. The Fed will now double that to $30 billion per month, which would put an end to the so-called quantitative easing program by March of next year. Now, there's a lot to unpack in this Federal Reserve announcement, a lot of language changes. The big shift really to a faster taper has to do, of course, with inflationary pressures. The Federal Reserve no longer describing inflationary pressures as transitory. Instead, the statement says, quote, supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to elevated levels of inflation. On the job front, the Fed described job gains as, quote, solid in recent months, and the unemployment rate has declined substantially. Now, what's interesting is that the Fed did say that risks to the economic outlook remain, including new language that says if this includes new variants of the virus. Now, the Fed is also trying to balance its approach to tapering alongside its reaction function to eventually raising interest rates. And those that are in the know that this Fed announcement also came alongside a set of economic projections, what they call the summary of economic projections. If we unpack the dots that are in there, which map out the 18 members of the FOMC and where they see interest rates going in the next few years, notable to see that none of the 18 members of the committee see the case for holding interest rates at near zero through the balance of next year. Instead, the median member of the FOMC now sees the case for 3 interest rate hikes by the end of next year. So certainly a much more aggressive Fed than what we had seen telegraphed in September, where you'll recall 9 members of the committee saw the case for no interest rate hikes next year, but the other 9 saw the case for at least 1 interest rate hike. If you look out to 2023 and 2024, you have a number of other possible interest rate hikes as well. In fact, if you actually look at the 2023 projection, the median member sees another 3 to 4 interest rate hikes that year, with another 1 or 2 in 2024. And also, a lot of this is because of those inflationary pressures. The projections in the SEP have the median member of the FOMC projecting 2.6% inflation as measured by personal consumption expenditures. That's a notch up from the 2.2% that we had seen in the September projections. So there's a lot to unpack in this statement. One other thing that's worth noting with regards to the framework, the Federal Reserve actually changing its language with regards to its announcement that it was going to hold interest rates at near zero in this particular meeting, which was expected. They said the committee, the committee expects it will be appropriate to maintain near zero rates until, quote, labor market conditions have reached levels consistent with the committee's assessments of maximum employment. So the Fed really trying to put the pedal to the metal on the idea the labor market is going to tell them when to raise rates. But again, the big headline, Fed doubling the pace of the taper. None of the 18 members of the committee seeing the case for holding interest rates at near zero next year, guys.
Brian, it's Adam. Quick follow-up, and it's not something the Fed would answer to, but I imagine Jay Powell might get asked about this. President Biden's going to be appointing new members to the Fed next year. We're going to have new presidents at some of the Federal Reserve banks. How likely is it that the dot plot will change at the next summary of expectations release in March?
Yeah, well, certainly when it comes to the kind of composition of the Fed, in fact, even before we got those announcements, we already knew this committee was going to look very different. First of all, we have 2 regional Fed presidents in the Dallas Fed and in the Boston Fed who were temporarily replaced because of the trading scandal we had saw engulf a number of Fed officials a few months ago. Now, that aside, we also have some departures that are regularly pre-scheduled. Randall Quarles, whose term as vice chairman of supervision expired in October, will be leaving at the end of this month. I believe this is his last meeting. And then Richard Clarida, the vice chairman of the Fed itself, will be leaving in January of next year. So there's already 4 officials right there that could be turned over. And then you also have those vacancies at the Fed itself, which the Biden administration could fill in. At least 3 they could fill in. Of course, we don't have those names quite yet. The administration had promised to nominate people before the holidays, so we'll see. They only have a few more days left to make those announcements, but the composition of this Fed could indeed change, and that means the dots themselves could change because, again, each of those 18 at its max, actually 19 members of the committee get to plot out where they see interest rates going. If you have at least 4 people turning over next year, that means that those dots could certainly move next year. But of course, we only get these projections on a quarterly basis, which means the next time we'll get a read will be in March. And as you mentioned, Adam, the Fed could look very different by that point in time.
All right, Brian Chung, thank you so much for that report. We will stay on the report and the decision and bring in our next guest, Michael Cox, former chief economist for the Federal Reserve Bank of Dallas. Sir, thank you so much for being with us today. And just want to get your reaction. A pretty aggressive move by the Fed, I would say, doubling the pace of tapering to 30 billion. That shows no longer transitory, using language calling it elevated. And then the median estimate is for 3 rate hikes next year. Your assessment, sir? Is for 3 rate hikes next year. Your assessment, sir?
Well, I'm not sure it's aggressive enough. I think the Fed may have gone too far during COVID. Okay, first of all, the money supply, the M2 money supply seems to be the measure of the money supply to which the price level is the most closely related, but with a lag. Put the money out today, prices rise tomorrow. During the COVID, if you go back to February of 2020, from that point in time till today, the M2 money supply has increased 38.5%. That's almost 3 times the amount that the Fed let the M2 money supply increase by during the Great Recession. They probably overdid it. Now they're saying they're going to increase the pace of tapering, meaning they're going to slow down the increase in the money supply. But I think there's too much money out there already to staunch this rising inflation, meaning they're probably going to they may have to eventually have something like a mini midnight massacre where they raise rates up to a high level if they keep putting off the inevitable, which is to cut the money supply and raise rates a lot. Already we're seeing these inflation expectations being incorporated into rates because the Fed's language is now starting to say, hey, this is not going to be a temporary thing. So the real damage here that could be done is by letting inflation stay high long enough for inflation expectations to build, long-term borrowing rates rise, mortgage rates rise, and then we have a further slowing of the economy because the Fed continues to try to solve a problem with expansionary monetary policy that expansionary monetary policy can't fix.
Michael,
this is not a problem. Yes.
Hey, it's Adam. A quick question for you. Most of us experience inflation with prices going up, but at the Fed, they're looking at purchasing power. So the steps they took today will strengthen the dollar, will they not? And will that help us, whether we're investors or consumers who are paying double for a half gallon of milk? Will that help us with our purchasing power and then bring inflation somewhat under control?
But don't forget, there's a big lag. The steps that the Fed are doing today won't really help until we see a much lower rate of inflation. But we're not going to see that for a while because the money supply is going to continue to grow just at a lower pace. And we still have that 38.5% increase in the money supply that happened from February to 2020 till today to go further be out there and increasing prices even more because of the lag. So yes, it will, 2 or 3 years from now, 2 years from now, what the Fed is doing today will make it better than it otherwise would have been, but we still have pain to go through.
And Michael, just looking at the summary of economic projections, specifically on the employment front, unemployment rate projected to be 4.3% for 2021. Previously, it was 4.8%. It looks like we're approaching maximum employment, which is the other mandate of the Fed. I'm just wondering, how do you see the labor market evolving? And do you think the Fed has just placed way too much importance on inflation, or excuse me, way too much importance on inflation at the expense of employment?
I don't think the employment has ever been something that the Fed can do that much about. It was something that was assigned to the Fed by the Full Employment and Balanced Growth Act of 1979, but that was just making Fed the whipping boy of Congress, when the Congress would make all kinds of rules and regulations which slowed the economy, and then blame the Fed for the slowing of the economy. Said it's your job to keep the economy going. But the Fed's job is the price level. The Fed's job is inflation. And that's the government's job, the fiscal authority's job, and the regulators' job is to create the right kind of policies which make the economy grow. Well, unfortunately, like you said, we're getting down to very low unemployment rates. Last month, we only added 210,000 jobs, which is far below what we've been adding on average post-COVID. It's the lowest job growth we've had in the past year. So we're running out of people who want to go to work. And that's not something the Fed can solve through pushing money into the economy. Right. So we're having stagflation and rising inflation expectations.
There's that word.
There it is.
You said it. Stagflation. Hopefully we don't see a repeat of the 1970s. We got to leave it right here. Michael Cox, former chief economist for the Federal Reserve Bank of Dallas, but we want to continue the conversation with Sarah Howe. She is a Wells Fargo senior economist, and you've been listening to our commentary here. What's your initial reaction to this report here?
Well, I think we've seen the Fed finally get concerned about inflation. So we see that with the upward revisions in terms of the summary of economic projections, both in terms of those inflation forecasts, but also, of course, those moves in the dots. So I think they've come around to the view that we are going to see these bottlenecks persist, and that you have seen this tremendous demand that's going to take some time to cool off, and will probably take some somewhat tighter policy in particularly in areas that are interest rate sensitive.
Hey, Sarah, it's Adam. I want to get back to this concept of purchasing power. The steps they took today, is it really going to take 2 to 3 years to see that really materialize? Or with the dollar going up in value just by an announcement that tapering will be faster, doesn't that help me as a consumer and as an investor?
I think given the inflation that we're seeing today, the impacts of the dollar are going to be pretty limited. So, you have to remember when we think even in import prices that most contracts are already priced in dollars. So I think the efficacy there is limited. I think so much of this comes down to the overwhelming consumer demand that we've seen in the wake of the COVID pandemic, and just the issues with supply chains and manufacturing globally, keeping up with this, creating this inflationary bout. And so I think it is going to take some time to essentially normalize these patterns, and with that, some tighter policy.
And I wonder, from the announcement, it says job gains were quite solid according to the decision. How close are we to full employment? And do you think the Fed has abandoned that part of the mandate to some degree to focus on inflation?
So I think they are giving more weight to inflation right now, given that it's what's really out of bounds with its goals. And the fact that we have seen this improvement in the labor market allows them to focus more on the above target inflation. So they're not having to weigh one versus the other quite as much. But given the fact that we have seen the labor market tighten tremendously, even in just the past few months. So over the past few months, we've seen the unemployment rate drop a full percentage point. I think that has allowed them to focus more on inflation for what seems to be quite a change from what we've seen over COVID and really the prior cycle.
And Sarah, this seems to be a somewhat hawkish report, but nevertheless, I'm looking at stocks, and the initial reaction is to the upside. Also seeing that, given the fact that the members of the Fed are expecting 3 rate hikes next year. That is the median number. The Fed OIS swaps, I'm just reading this headline right now, is now reflecting that. So what are the odds that the market is just comfortable with everything that's coming down the pike here, including potentially 3 rate hikes next year?
Well, this is a big shift from the September summary of economic projections, but it's not necessarily a big shift from what the market was already pricing in ahead of today's meeting, based on some of the more recent commentary that we've had from officials and the recent data. So markets were already, roughly pricing in 2.5 hikes. So the fact that the dot plot shows 3 for 2022 isn't that much of a change. When we look at where the median rate is for 2024, it's not much higher than where it was prior to this. So I think what we're seeing here is that these changes were well telegraphed. And so I think that's at least helping for now. Things seemingly stay pretty smooth.
Sarah, when they say that inflation is basically the result of the supply-demand imbalances, are they missing something with the tremendous amount that they're holding on the balance sheet? And when Jay Powell's asked about this, what would you want to hear his response be?
So I think in terms of those supply-demand imbalances, it comes from everything from the amount that households are spending on goods, but also even what's considered services like housing. So the fact that we have seen preferences shift in light of the pandemic. Now, part of that strength in housing costs, that is one of the big factors fueling the more recent momentum in inflation, is from the fact that we have seen such low rates that's allowing these higher prices. And so I think that does play into it to some extent. All right, we will have to leave it there. Sarah House, Wells Fargo senior economist, thank you for your insight today. I want to get a quick check on the markets because they are reacting to the decision that came out. So if we look quickly at the 3 major benchmarks, we can see that we pull up those numbers. The Dow is now up by 133 points. The S&P also up by 20 points. The NASDAQ also in positive green territory, up 40 points, all at session highs on this news. And with more on market movers on this decision, let's turn it over to Yahoo Finance's Inez Ferre. Inez, what are you watching?
A close look at what happened with the markets when that Fed decision came out. Take a look at the Dow Jones Industrial Average. So you saw a little bit of a knee-jerk reaction to the downside, just a tiny bit, but then shot right back up. So right now, as you're mentioning, the Dow up 0.3%. The NASDAQ, same type of movement right here, and the S&P 500 as well. Taking a look at the 5-year T-note, we are watching that go higher, up 5 basis points. Also, the 10-year T-note up 3 basis points, and the 30-year bond, taking a look, it's up 2 basis points. Also want to mention the US dollar index because we've seen that shoot up. It was up about 5 basis points before that decision came out. It's up about 22 basis points now. And then looking under the hood at where we're at with stocks, we are watching these sectors which you had seen, utilities and real estate, some of the defensive sectors higher this morning. They are still higher today, but the losses here, pairing some of the losses that we had seen in some of the other sectors that had been lagging earlier today. So just looking at the NASDAQ 100, we watched some of these mega cap names flip into green territory. Apple up 0.7%. Check out the movement here from after the decision came out. Microsoft also in green territory, as well as Facebook. And then just looking at Bitcoin, we have been watching the cryptocurrency space. Bitcoin, Ethereum, these higher as well after that decision.
And we thank you for that report, Yahoo Finance's Inez Ferre. And we want to continue the discussion with Michael Gapin, Barclays chief U.S. economist. Michael, great to see you here. Always great to see you, especially on Fed Day. This is arguably a somewhat hawkish report, but we're seeing risk markets rally. What are you making of this?
Well, thank you for having me on. It is always fun to do this on Fed Day. I think probably what the market is reacting to is the cumulative number of hikes that are in the median, 3, 3, and 2, so only 8. So leaving the funds rate short of where most on the committee think is neutral by the end of 2024. Perhaps the concern was that the Fed felt it was far enough behind inflation that it would need to put the terminal rate above the neutral rate, over tighten to bleed out some inflation and inflation expectations, which would have been a negative for risk assets. So if I had to guess, it's probably more about the terminal rate than it is about the pace of hikes between now and 2024.
Michael, for investors, if we're looking from now until the next meeting in March when we get the revision of the summary of economic projections, in real world terms, over the next 3 months, what does the tapering speed up mean for me as an investor?
I think that the way that I would frame that is that the Fed said coming out of its November meeting, it said this in the minutes, it said risk management is now the guiding principle in the conduct of policy. So tapering isn't so much about whether we buy a few $100 billion more or a few $100 billion less. The Fed's already purchased about $5 trillion in securities. That's rounding error on what the Fed holds. I think it says something about the Fed's willingness to move to rate hikes. So I think in a risk management world where we're responding to risks around inflation as much as where inflation is currently, tapering faster says something about a willingness to move to rate hikes. And I think that's how investors need to absorb it. It's not so much about whether we're buying, whether purchases finish in mid-March or mid-May. I think it's more about the willingness and the desire to remove accommodation going forward.
Would that mean liftoff in March?
Well, that is actually our baseline. We were coming into this meeting thinking 3 hikes next year and a hike in March. So the statement actually leans the outcome today so far leans in the direction that we're thinking. Certainly the Fed could get in 3 hikes, hiking in June, September, and December. So it's not obvious that it has to be March. But read what the statement says. The statement reads as if the Fed has already declared that it's met its inflation mandate. It says inflation's running well above 2, and the unemployment rate has fallen. And when the unemployment rate reaches maximum employment, then we're going to lift off. So that could very well be March. The unemployment rate is 4.2. The statement says it has fallen substantially in recent months. So we suspect if that progress continues, the Fed could find itself in a position where a March liftoff becomes appropriate.
This is certainly, a big pivot from the September decision that came out. And so I'm wondering, how careful does Fed Chair Powell have to be in his comments coming up in a little bit to make sure that he navigates this just right?
I think the way that I would respond to it, you're exactly right. It's been a very big pivot. It's even been a big pivot since the November meeting. Remember, he was doubling down on transitory at the November meeting. So in just a few short weeks, it's been a big change. So the way I would say it is this: the Fed is willing to surprise markets on cuts or easing policy. It doesn't want to surprise when it's tightening. So and faster runoff and obviously pulling in the dot plot is a form of tightening. So the Fed was clear. He was very clear in his messaging in front of Congress. He repeated it. I suspect you will hear him repeat that today. So today is all about, in my mind, completing that hard pivot and coming out of today's meeting, sending the message, we think we're there on inflation already. It's about waiting till the labor market gets to full employment. We're ready to transition from tapering to rate hikes next year. And in the market, as I think your prior guest said, the market's already pricing a lot of this in. So this is really the Fed coming around to where the market is. And I think the chair shouldn't leave wiggle room. He should complete the pivot today when he speaks at the press conference. Yes, Omicron's a concern. Yes, there's uncertainty. But I would say don't back away, just deliver the message. The market is already there, and then I think things will be fine, and you can wait to see how the economy evolves.
And Michael, we're talking about 2022, but we don't even know what the composition of the Fed is exactly going to be. We know Chair Powell is going to remain the chair, but we have a number of Fed officials, some of whom are leaving under inauspicious circumstances. What does leadership look like at the Fed next year, and what kind of a headwind is it, the fact that we don't know exactly who's going to be at these meetings sometimes?
Yeah, that's obviously there's a lot of turnover, and you make a very good point. I would just remind people that dissents within the Board of Governors are rare. So if it is indeed Powell delivering this message, and this is the course in which the chair wants to go, the chair and the vice chair, Powell and presumably Brainerd will both be confirmed. If this is the direction the leadership wants to go, I would suspect the new appointees, particularly on the board, would support it. So I'm less concerned about that, but you're right, the names are going to change. And we need to hear and see where those people are. But this seems to be a clear shift, a clear pivot. And I would say the divisions within the committee have now been resolved in the direction of removing policy accommodation sooner than later. So I think the trajectory is there, and we should listen to that.
All right. right, Michael Gapin, Barclays chief U.S. economist. Thank you so much for your time today on Fed Day. And of course, we're all awaiting Fed Chair Jay Powell's comments coming up in just about 7 minutes from now. But before that, we'd like to bring in a panel of guests: Dana Peterson, the Conference Board chief economist, and Jeanette Garrity, Robertson Stevens Wealth Management chief economist. Thank you, ladies, both for being here today. I want to start with you, Dana, and just get your perspective on what you think of the decision that came down. It was fairly hawkish. The market's sort of liking what they see. So how much of this has already been baked in, do you think?
I think a lot of this has already been baked in. Certainly when you look at OIS, Fed Fund futures, markets were already anticipating 3 rate hikes for next year. And the Fed really delivered in terms of the dot plot moving higher. And certainly, I think what's maybe keeping markets a little bit calm is that the Fed isn't looking for 10 or 12 rate hikes over the course of the next few years. It's still 8. And still, even if we have 3 hikes next year, we're going to have interest rates that are well below the averages that we saw decades ago. And even with 8 hikes, we'd still only be about 2%. So I think with all that, markets are probably taking into account the fact that inflation has been very high. Meanwhile, the labor market has been healing, and the Fed really does need to act. And this ripping the Band-Aid off, so to speak, was very important to do today.
Hey, Dana, it's good to see you. It's good to see you too, Jeanette. Let me throw this question to Jeanette. As investors, as consumers, what's going to change in our lives over the next 6 months? Is it going to be mortgage rates? Is it going to be, credit card rates? Where are we going to feel whatever's about to happen?
Well, it's interesting you cite rates, right? Because that's going to, I think that's going to hang on when the Fed decides to start actually raising short-term rates. And then one would expect over time that all those rates would move up together. But I don't think much is really going to change in 6 months, which is why Fed policy mavens always know it takes 9 to 12 months for any policy action to feed its way into the economy. So not much in 6 months. I think this is very much a story about the second half of 2022, actually. And I agree with the comments beforehand that the good news about this press release is that this is what everybody was thinking and was sort of baked in. But you notice that the market is now coming off where it was in kind of a relief. I got to wonder if the first reaction being way up was, yeah, we knew this, but now it's done. Good, we can go do the holiday parties. And now half an hour later, people are thinking about exactly what 3 rate hikes mean. It is a very hawkish press release. Absolutely think it needed to be done. Absolutely, but it's hawkish.
And Dana, we were talking with Michael Gapin of Barclays just a few minutes ago, and he said his belief was that the market is reacting positive to this. We have stocks up right now off of the announcement because maybe the terminal rate, the total number of rate hikes, looks like it's only going to be 8. That's what the FOMC members are expecting now. I'm just wondering, do you agree with this, or how are you viewing the summary of economic projections data that we got today?
Sure. I think certainly, again, markets are looking at the number of hikes and seeing that it's not different relative to the prior SEP, even though they're accelerated. And I think, the big concern is if we continue to have elevated inflation, what's it going to do to economic growth? Now, we noticed that the Fed did raise its expectations for growth next year and then lowered them a little bit for 2023. So they're anticipating that their actions are going to dampen growth, certainly in 2023. But still in all, that's pretty much the average where we were before the pandemic. We were growing around 2.25%. So the Fed's actions still suggest that we're going to have very robust growth. The labor market's probably going to continue to tighten. We're probably going to continue to have labor shortages that are going to feed into wages and consequently consumer inflation. So it makes sense that the Fed is doing this. And I think markets are starting to absorb the benefits of the Fed deploying less accommodation in terms of monetary policy.
And Jeanette, I want to ask you, the wild card in all of this could be, if we get any insight into the balance sheet. It's currently at 8.7 trillion. It was 4 trillion before the pandemic. When does that likely get reduced? Do you think we hear anything from that? Because obviously he's going to be asked that question.
I think he's going to be asked that question, but I would be surprised if he really talks much about it. I think the big storyline, and he's going to stick to it, is the taper and the interest rate movement. Remember, in previous press conferences, he hasn't even touched the issue of interest rates. He's avoided it like a plague. So now he's going to talk about it. That's going to suck all the air out of the room. And by the way, I want to call attention to in the summary of economic projections, the most interesting number to me is the long-term outlook for 2024 and beyond. The signal is 1.8 to 2% GDP growth. That tells me that the Fed is thinking in terms of a very different labor force, population growth and labor force growth than they were anticipating 2 years ago or 3.
This one's for Dana, because so much of what your employers do is based on consumer sentiment. How are the average men and women hearing what we're talking about going to feel going forward? It's not really going to impact any of that, is it?
Well, it depends on who you are. If you're looking to buy a home, you're probably shaking your boots right now because you know that mortgage rates are going to rise, and the mortgage rates are going to rise much more quickly than inflation is going to fall off. And certainly, I think that the average person will probably feel internally that it's great that someone's listening to us, that they understand our plight, that we are seeing an erosion of our purchasing power, the rising prices for everything from food to shelter to energy and even discretionary items. It's really harming us. And so I think the signaling will be positive. However, they probably won't feel it for some time.
And Jeanette, we're still waiting for Paul here. I might have to cut you off, but
Yeah.
I'll give you the floor here. Anything else on your mind that you'd like to raise ahead of this press conference?
I think building on what was just said about how consumers feel, I think investors also.
I'm sorry to cut you off, but we have Chair Powell. He is at the lectern.
Given us maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 percentage points since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you, Mr. Chair. We'll go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment. And there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So as I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment. And you see that in, of course, in some of the factors that I mentioned.
Great, thank you. Steve at CNBC.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road on the current inflation problem? And aren't you actually lengthening that time by continuing to buy assets such that it could be not until the long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem?
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement. And I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of, a year or 18 months, shorter than that, rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was, I think, fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But that's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance was that was given was for the Fed funds rate to remain at the target level.
Okay, guys, sorry to butt in here, but that's great news. Meaning they're not raising the rates until the taper is done. So Bitcoin is not going to crash today. It is not going to dip down at all. So there's not going to be extreme fear hitting the market now. So short-term selfishness is paying off for people that have their money in cryptocurrency. And if you were planning on buying more, you can now do it because the market will maintain its sketchiness over the next few months. And back to it.
And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Timoros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year? And if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020. And I think early on, the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different. And the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We certainly welcome the 0.2 improvement that we got in the November report, but I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that would have pulled people back in, but really it's the pandemic, it's a range of factors. But the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now, and inflation is well above target. So this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. On top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings, you're comfortable the economy can handle it without quantitative easing.
Yes. I think if you look at the state of the economy and the strength of demand, the strength of just overall demand, the strength of demand for labor, look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do, and I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
Hey, Chair Powell. Thanks for taking our questions. I wonder could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Sure. So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year. And we had a view, it was very, very widely held in the forecasting community, that this would be temporary. It was quite narrow. A limited number of factors were causing it. And there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month, monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, we started to see, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. We moved the taper forward, and it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the employment compensation index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report and revisions to prior readings and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today, as you can see, unanimous vote. But beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation, and how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4% and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, that's still basically the way that you know that you're there is inflation. So is that understanding correct? And are those signals likely to be clear right now, given that you have inflation that's caused by these supply chain disruptions that might also lead to inflation in wages and those sorts of things? So how do you sort of tease out the signal of maximum employment?
Okay, so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with strong monetary policy and fiscal stimulus into an economy that was recovering rapidly and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at, and it's. So I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment rate, different age groups of prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus, and wages. That's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job, and there's record amounts, historically high levels of that going on, suggesting again that you've got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market conditions that are consistent with maximum employment. And so that's how we think about it. But one of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. Let's say we knew that it would start to move up in 2 years, would we wait 2 years or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and it's you're not certain whether you're at maximum employment? I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, absolutely. I think, well, whether or not we say we're at conditions, labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would certainly, we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation. And I wondered, what do you think needs to change in the economy to kind of get a meaningful recovery in labor force participation? And also whether running the economy hot, like in the last expansion, is one way of doing that.
Well, the labor market is by so many measures hotter than it ever ran in the last expansion. If you think about it, you know, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? You know, that really, why is it low is the question. So there are a bunch of answers, and all of them probably have some, you know, some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of childcare made for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one income rather than a two income family. The same thing with people's houses. People buy they have a mortgage, and with leverage and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back because they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And the number one thing it would really be to have the pandemic get under control. That's what everyone would really like to see. What does the labor market look like in a world without COVID? That would be the thing that we'd really like to see. But it doesn't look like that's coming anytime soon.
And just to quickly follow up on that, if some of the reason that labor force participation isn't back to, February 2020 levels because people are voluntarily making life decisions that are different, does that make you think we're going to end up at a lower rate overall?
Well, there's a demographic trend underlying all of this. And we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down because in an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower and that over time participation would move down. The question of how much we can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And I mean, what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. I mean, really, it might be one of the two big threats to getting back to maximum employment is actually high inflation. Because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data there for estimate monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases are being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased. And I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk. And I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months. But we are prepared to use our tools to make sure that higher inflation doesn't get entrenched. For one reason, as I just mentioned, it's one of the two big threats, the other being the pandemic itself, to getting back to maximum employment.
Let's go to Michael Derby, the Wall Street Journal.
Yeah, thank you for taking my question. So as the Fed shifts towards an accelerated taper, I wonder what your read is on financial stability risks right now. I mean, these periods can be, it seems like the taper process has gone fairly smooth so far, but what do you see in terms of stability risks? Are there any parts of the financial sector that concern you right now? And are there any significant systemic issues that are on your radar, maybe from the cryptocurrency sector or something like that?
We have had now for a decade and more a 4-part financial stability framework that we use, so we can hold ourselves to the same kind of framework and not just treat each event individually. And there are 4 key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability, that's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. It's the emergence of a new variant that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot's happening in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated. And right now they aren't. And they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist. And you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the cryptocurrencies that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
Chair Powell. Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curve on getting inflation under control?
So I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do, and I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that if both the effects and the persistence of inflation, of bottlenecks and labor shortages and things like that. So we've been calling out the fact that were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take, in a thoughtful manner to address all of the issues, including that of too high inflation.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you. I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, they are separate tools. So the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation. It just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that obviously in coming meetings. I don't think that the last cycle there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5%, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff
in the last cycle.
So with the balance sheet, we did have a balance sheet discussion. It's our sort of a first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another after the meeting, at the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. And but to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So haven't made any decisions at all about about when runoff would start, but we'll be continuing to, in relation to when either liftoff happens or the end of the taper. But those are exactly the decisions we'll be turning to in coming meetings.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean the stimulus was mistaken, or is the inflation just a consequence of that we have to put up with because of that?
No, I'm not expressing any judgment about the stimulus in that comment. What I'm saying is there's a sense among some that you wanted inflation. This is what you wanted. How do you like it? And the truth is, this is not the inflation what we were talking about in the framework was inflation that comes from a tight labor market, right? So we had 3.5% unemployment for a period, and we had inflation that was just barely getting to 2%. And I think in that setting, our thinking was we can afford to wait to raise rates until we see actual inflation rather than preemptive, because no one had seen what 3.5% unemployment would look like with high labor force participation. By the way, no one had seen what it would really look like for an extended period for decades, and we didn't know what the inflationary implications were. Turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework. This is something completely different. That's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes, and all that kind of thing. People will judge in 25 years whether we overdid it or not. But, the reality is we are where we are. And, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end. And it makes sense that's reacting to changes in expectations for policy. I think a lot of things go into the long rates. And the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get, a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think there may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We ended up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. I mean, we're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Thank you. For the last question, we'll go to Greg Robb.
Thank you very much. Chair Powell, I was wondering if wanted to give you the opportunity to talk about something I've heard that's been discussed, that your pivot towards a tighter policy, hawkish policy stance had something to do with the timing of your re-nomination by the president. Thank you.
Sure, I'd be happy to talk about that. So as I mentioned, we got the ECI reading just before the November meeting. We got the labor market report 2 days after the meeting, and then 1 week after that, I think on the 12th of November, we got the CPI reading. It was really the CPI reading in concert with those two, and I just came to the view over that weekend that we needed to speed up the taper, and we started working on that. That's a full 10 days or so before the president made a decision on renominating me. So honestly, it had nothing to do with that at all, and I just thought this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a faster taper before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
Just a quick follow-up. I guess that some people are saying that it was the the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation, and perhaps that you didn't push back as much as you might have otherwise.
I didn't push back at all. And the reason I didn't, and there was lots of talk about that, but not from the Fed, because that is not our job. We are not the CBO, and we're not elected by anybody. So we take fiscal policy as it arrives at our front door, and we don't comment. We make our own assessments inside the Fed, but it's really not our role. And I think very important that we stay out of that business, no matter who's in the White House, who's in Congress. It's just not our job, and it's something we avoid pretty assiduously.
Thank you.
Thank you.
Thank you, Mr. Chair. Thank you, everyone.
Well, pretty good
Welcome
news.
to Yahoo Finance Live. We've got an hour and 29 minutes to the closing bell. I'm Adam Shapiro, along with Emily McCormick. We've been paying attention
It's all good
to the
news for
Federal
crypto,
Reserve
everybody.
Chairman
This is all
Jerome
good.
Powell talking about the last meeting and the statement from the FOMC. The highlights, of course, are the potential with the dot plot from the Summary of Economic Projections telling us there could be 3 interest rate increases next year, but also a pivot away from transitory inflation to now doubling the tapering. Let's get right to Brian Chung, who covers the Fed for at Yahoo Finance, with the takeaways not only from the statement, but from what we just heard during the press conference with Chairman Powell. Brian?
Well, it's been a very eventful afternoon, so let's just kind of rehash exactly what happened here. The Federal Reserve announcing that it is going to double the pace of its taper. Again, the Fed had been pacing a wind down in its asset purchase program to end the whole so-called quantitative easing program by the middle of next year. Now, this sped up process, as outlined today, would finish that process by March of next year. And the Fed also, alongside that, had a round of dot plot projections. This is kind of a map for where the 18 members of the committee could see interest rates going over the next few years. And whereas 9 out of 18 in September saw the case for no interest rate hikes by the end of next year, the new update actually shows none of the 18 members of the committee seeing the case for holding interest rates at near zero through that time frame. In fact, the median member of the 18-member committee sees the case for 3 interest rate hikes by that time. So very much a big change between September and December. So naturally, the big question to the Fed chairman during this press conference was, why the change? And what was interesting was that the Fed chairman pointed obviously to inflationary measures like the consumer price index report for the month of November showing 6.8% year-over-year increases in prices, but also an employment cost index report that actually came on the eve of the November 2nd and 3rd FOMC meeting. And the Fed chairman let it loose during the press conference today that he was actually considering for a hot second during that last meeting 6 weeks ago, having the conversation about speeding up a taper. So actually, the multiverse that we live in right now, it just happens to be the one where the Fed decided to follow through on that in December. But in another alternate universe, the Fed actually moved in November to have a quicker, speedier taper right out of the gate. So the Fed kind of noting here that they want to be ahead of the curve on inflation. The Fed chairman said in response to one question directly about whether or not he was behind the curve that no, he doesn't think so, that this is going to position them very well for interest rate hikes next year. My question to the Fed chairman a few minutes ago kind of concerns the financial conditions because you have bond markets at 146 basis points on the 10-year, kind of pricing in the doubt that the Fed could very steadily raise interest rates over the longer term, worrying that perhaps the Fed might perhaps invert the yield curve by hiking short-term rates above where longer-term rates are pricing in. That's something the Fed chairman says he's not paying attention to, at least for right now. The Fed is making it very clear that the labor market and the recovery on that front will be the Fed's guiding star next year on when to raise interest rates. Guys.
Well, Brian, and to that point, many of the questions during this afternoon's press conference centered on the labor market. And a key quote from this afternoon was when Powell said, quote, "We are making rapid progress towards maximum employment." What were your takeaways about how Powell and the committee are thinking about labor market conditions right now and how close we are to reaching labor market goals to potentially warrant a liftoff on interest rates?
Well, what was really interesting was that there was a conversation about the labor market where the Fed chairman was saying the one indicator where he feels like he would like to see more progress is in labor force participation, because it's been kind of flatlined despite the fact that the headline unemployment rate has come down so much in this post-crisis recovery. So the Fed chairman said that the labor market does indeed have some metrics where they would like to see better improvement, but that on the whole, an unemployment rate that has been taking down faster than the Fed had expected is very much good for what the Fed is trying to do here in terms of engineering a return to maximum employment. Because keep in mind, the Fed had assessed the economy as being at full employment when the unemployment rate was at 3.5% in the months leading into the pandemic in early 2020. Now, what's also interesting was one quote, I want to read it to you kind of verbatim. He said, quote, "The labor market is by so many measures hotter than it ever ran in the last expansion, if you think about it." And what he was trying to get at here was just kind of the worker power that exists out there right now because of the fact that hiring firms have so many vacancies to fill. When you take a look at the JOLTS report showing 11 million job openings, workers are in a hot labor market from the perspective that the ones that are searching for work have a lot of optionality, a lot of higher weighted jobs that they can turn to with the same skill sets. But it's still not necessarily a tight labor market because of the fact that you still have almost 4 million fewer people in the labor force itself compared to pre-pandemic levels. So when it comes to the labor market, very tricky to assess. It depends on what side of the coin you're looking at, which is definitely going to be a conundrum if the Fed is using that as its guiding star for raising rates next year.
Brian Chung covers the Fed for us. You can read his articles on yahoofinance.com. Let's get right to our panel to talk about what we've seen in the statement, but also how this is going to impact those of us as consumers, those of us as investors. We bring in Mona Mahajan, Edwards Jones Senior Investment Strategist, along with Tony Rodriguez, Nuveen, Head of Fixed Income Strategy. It's good to have you both here. Emily McCormick obviously is joining us too. Let's first listen to what Chair Powell said about the hot labor market, and then we'll follow up with our panel after this.
The labor market is by so many measures hotter than it ever ran in the last expansion. If you think about it, you know, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter.
One of the reasons we played that soundbite is because, as Emily pointed out, the chair said that, quote, "We are making rapid progress towards maximum employment," and seemed to be linking achieving that goal when asked about what does that look like, maximum employment, linking that to lift off with interest rates. What do you think?
Yeah, look, there's no doubt that the labor market has been pretty strong this entire year. In fact, down to 4.2%.
All right, everybody. They're just kind of regurgitating information at this point. I just wanted to close off by saying that This is great news for crypto because what they've done is they've essentially, they're not increasing interest rates at all until they finish the tapering off of their asset buying, which is at the end of March. So this is brilliant news for crypto. It means there's not going to be a dump. There's not going to be a pump. Matter of fact, there might be a pump because everybody was waiting until now till they buy. So the prices are probably low right now and for a short time. So I expect that everything is going to do good, including altcoins. So get ready, guys. I know right now it's probably really expensive gas fees, so try to buy things right now that don't have any gas fees, and then try to wait till tonight to get those rare altcoins you've been waiting for. And that should do it for now. All right, everyone. Leave your comments, questions, and whatever you want me to stream about till next time. All right, take care.